Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello friends, so this new topic what was introduced, right, basically distress company valuation, on that we are going to solve a few problems. Just to recap the basic concept, we had two methods. One is modified DCF and the one is DCF plus distress value. First let us look at modified DCF. If you recollect, whatever we discussed, modified DCF, I'll just explain what the process is. You basically estimate, there are multiple steps in this. So what you do is, step 1 was you take cash flow distribution. So let's say year 0 and then you have cash flows 0, 1, 2, 3, 4. Now for this period, let's say the cash flow is there. Cash flow let's say is 10. It could also be 15, it could be 20, it could be 40, whatever. For each of them there is a probability distribution, 0.2, 0.3, 0.2, then 0.3. Like that, there's a probability distribution. Like that, there is a distribution of probabilities and cash flows for each of the years. So for each year, there is a cash flow associated with a specific probability distribution. So probability, cash flow, probability, cash flow, probability, cash flow, like that. Okay. Now, when you have such a distribution, right, you compute the expected cash flow for a single year by multiplying these two numbers. So you get an expected cash flow. Okay, this is one step. And you also factor in the default rate. So when you say this 0.2, 0.3, 0.2, there's also a case where there's a probability of default, at which point of time the cash flow may be there, may not be there. Okay. Second step is, after doing this, you compute unlevered KE. Then you look at what is debt and cost of debt. When I say debt, what is the basically debt equity ratio, how much can it be, and all of that, and then cost of debt. You update this cost of debt for obviously the probability of default and all of that, probability of default. If there is high probability of default, obviously the cost of debt will be high, right? So you consider all of this and then you do a DCF. Okay, this is one method. If you don't have all this, entire working of distribution of probabilities and cash flows and all of that, then you do expected cash flow is equal to cash flow in a period into 1 minus probability of distress. Okay, remember this formula. Now, we are going to solve a problem specifically associated with this. Now, let us go and look at a problem. I'll just clean this up. X Limited is currently under distress, okay, as it is unable to pay its vendors due to a steep fall in revenues and profits. Very good. The company has no debt and is fully equity funded. No debt, okay, no problem. Compute the distress value of the company under modified DCF method if its next 3 years cash flows along with probability of distress are provided below. Next 3 years cash flows and each year what is the probability of distress. The company is expected, and there is also a word may, company is expected or may revive after 3 years. So after 3 years it may revive. So the terminal value of the company is at the end of 4 years, not 3 years, at the end of 4 years is 10x of last year's cash flow. So basically they are saying third year cash flow into 10 times is the terminal value of cash flow at the end of the 4th year. So we compute the 4th year cash flow or we compute the terminal value at the end of 4th year, which is basically 10 times year 3's cash flows, and discount by 4th year present value factor. Okay. Then the discount rate is 14%. They have said directly what is the discount rate. Now what have they said? Period 1, period 2, period 3. This is the cash flow. And there is a probability of distress, and they have also given this last period. I think it didn't get printed, so I had to manually write. Terminal period, what is the probability of distress? Okay, now they have given something like this. Now, is this question there in the study material? No, but I have created a question based on whatever concepts they have taught, so that if at all such kind of question comes up in the exam, you are in a position to answer. Will exactly same kind of question come? I don't know, man. I mean, I have created a problem based on what institute has given in the material. Something similar could come up. I am giving you a framework in which you can think. Okay. Now, what is the formula we had? We had this formula. Expected cash flow is cash flow of a period into 1 minus probability of distress. So let me write solution. Under modified DCF, expected cash flow is equal to cash flow for a period T into 1 minus probability of, and this is expected cash flow for a single period. Okay. Now what we will do is, in our case, we have been given 3 data points for year 1, 2, 3 cash flow and probability of distress. So minus 40, 60, 90. So cash flow, probability of distress, 1 minus probability of distress, cash flow into 1 minus probability of distress, present value factor. Okay, what is cash flow? Minus 40, 60 and 90, right? Yeah, 60, 90. Also put year 1, 2, 3, 60, 90. Probability of distress is 0.7, so this is 0.3. So you see probability of distress is actually coming down, 20, 10 and 0.05. 0.2 basically 0.8, 0.1 basically 0.9. Fourth year basically terminal value, we will look at it separately. What is terminal value? They said 10 times of last year's cash flow. What is last year's cash flow? 90. So 90 into 10, that is equal to 900, and probability of distress is 0.05. So 1 minus probability of distress is 0.95. Now you have to multiply this cash flow into 1 minus probability of distress. So minus 40 into 0.3 is minus 12, 60 into 0.8 is 48, 90 into 0.9 is 81, 900 into 0.95, 900 into 0.95 is 855. Present value factor at what? At 14%. So 1 by 1.14. I'll take up to 3 decimals, 0.877, then is equal to 0.769, 0.675, 0.592. Okay. I am taking up to 3 decimals. In exam, you can take, if they don't give anything, take up to 4 decimals also is also fine. But if they specify 2, 3 or 4, follow that logic. Okay. So what are the values? 12 into 0.877 is equal to m minus, 48 into 0.769 is equal to m plus, 81 into 0.675 is equal to m plus, 855 into 0.592 is equal to m plus. Memory recall, you get total of 587.223. Now what is the unit of measurement? I didn't even say what is the unit of measurement. Cash flow in lakhs, rupees lakhs. So value of X Limited, no, what is the name of the company? Value of X Limited under or currently under distress is rupees 587.223 lakhs under modified DCF approach. Okay. Very simple problem. See, I have created a problem that is extremely simple for you to understand from an understanding perspective. If you get a question in exam, maybe something similar, maybe slightly different, but you know how to approach this problem. That is the intent of this. Now, whether they will ask in exam or not ask in exam, which attempt they will ask, all that I don't know. Okay, but they've given a specific formula, they've given a specific process. I'm trying to, prepare you in advance if at all there is a surprise in the exam, so that you need not be surprised. Now, we have got under DCF approach the value of equity, right? Because the question very specifically says there is no debt. What if there was debt? Okay, let us assume if X Limited had debt of rupees 234 lakhs. Okay, 234 lakhs, and WACC is 14%. So I am changing only one number, that is I am introducing a new number called debt. If there is debt, how will you value? Firm value, whatever we found out, right? These cash flows pertain to whole firm. So basically think of it as FCFF. This discount rate, whatever we saw, is WACC. So you get basically the value of the firm. So firm value is equal to rupees lakhs 587.223 less debt 234 equity value. So basically you take total firm value, from that you subtract value of debt, you get equity value 353.223 lakhs. That's all. if they give debt value, and this is under this scenario, that is if they give debt in a very different manner, or if they make some other changes, you'll have to go as per the problem. In this particular problem, I have introduced one variation where I am saying that if the value of debt is 234, how will you arrive at the equity value by using the same set of data which pertains to firm instead of the equity of the company. Okay, this is first question. Now let us move to the next question, and this one will be DCF plus distress value. So in this question, right, we'll have a slight variation. What is it? DCF value plus distress. Okay, Y Limited is going through distress. Its expected cash flow in the next 3 years, if it revives, are as follows. In next 3 years, it cash flow year 1, year 2, year 3 is 300, 450, 700, no problem in rupees lakhs. The company is likely valued at 10x of year 3 cash flows, and here also same way, like previous question only, valued in year 4. In year 4 at 10x of year 3 cash flow as terminal value. That is, whatever is third year's cash flow into 10 times is the terminal value of cash flow on year 4 or in year 4. Whatever is year 3's cash flow into 10 times is the value of the year 4 terminal value. Okay, so year 4 terminal value should be discounted by 4th year present value factor. Okay, the probability of distress is 51.5%. If the company were to go through a distress sale, it would recover at the most 65% of its PPE, which is expected to be constant over next 3 years at 500 lakhs. So, and the Y Limited has no debts and its cost of equity is 14%. Compute Y Limited's value of equity. Now, for this, what is the formula? What is the formula for DCF valuation for distress value? For this, I am not going to actually go to the solution. First, I will write DCF into 1 minus probability of distress plus distress sale value into probability of distress. So, basically you are doing two things. 1 minus probability of distress, that is company is going to continue, then what is the value? Then company is not going to continue, what is the value? So, how will the solution look? What will the solution be? First, DCF value, year cash flow, 1, 2, 3, terminal value, then 300, 450, 700, and this is 700 into 10, because they said it is 10 times the last year's cash flow, correct? Company is likely to value 10x of year 3 cash flow as terminal value. The probability of distress is 51.5. We will come to that. They said cost of equity is 14%. Decimal they have not said. In this question, we will take 4 decimals because that is the best. 1 by 1.14 is equal to present value factor 0.8772, 0.7695, 0.6750, 0.5921. Okay, so what is the present value of cash flows of all of this? You would simply multiply 0.8772 into 300 is equal to m plus, 0.7695 into 450 is equal to m plus, 0.6750 into 700 is equal to m plus, 0.5921 into 700 into 10 into 7000 is equal to m plus. Memory recall, you get 5226.635. Okay, this is a DCF value. Now, what is our formula? DCF into 1 minus probability of distress. What is probability of distress? 51.5. So, 5226.635 into 1 minus 0.515, right? 51.5, right? Yeah. This is DCF. This is probability of distress. Then distress value, this plus distress value, which is how much? What did they say? If the company were to go through distress sale, it would require at the most 65% of its PPE, which is 500 lakhs, any time in the next 3 years. So, 500 into 0.65, this is distress value, multiplied by probability of distress, which is 0.515. So, you add both of these. Okay. So, what is this? 0.485, which is this number, into 5226.635 is equal to 2534.92 lakhs plus the second part, which is 500 into 0.65 into 0.515, 167.375 is equal to rupees 2702.295 lakhs. Okay, now here also again, if they give you the value of debt, you subtract the value of debt from this to arrive at the equity value. If there is no value of debt, this is a firm value and equity value are same. If there is a value of debt, firm value minus debt value is your equity value. Okay, fair enough. So we've looked at two kinds of problems. One is your DCF and distress, which is what we solved just now. Before that, we looked at modified DCF. Now, see, there can be many variations. I cannot imagine what all variations can be there, but I am giving you something which can be useful for you to think through. Okay. Then there is a third one, which is adjusted present value, APV, adjusted present value. Let us now look at a question on adjusted present value. So, guys, now let us look at the next question. Compute value of P Limited under APV. APV is adjusted present value. P Limited is going through tough times. Unlevered firm value is rupees 4321 lakhs. Distress sale value at 45% of plant, property and equipment is rupees 6143 lakhs. Plant, property, equipment of rupees 6143. Distress sale value is not 6143. At 45% of PP off. Okay, so PP value is 6143, of which 45% is distress sale value. And probability of distress is 34.67% over the next 2 years. You are required to compute the value of P under APV. Now, what is the formula for APV? Value of firm in distress under APV. It has two parts, firm value equal to, and in our case there is no debt. They have not given any debt details. If there is a debt element, we will see that later. Firm value is equal to unlevered firm value plus tax benefit from debt minus expected cost of bankruptcy. And what is expected cost of bankruptcy? Is equal to the cost of bankruptcy is, that is, what is it that you are losing because of going bankrupt, which is unlevered firm value minus how much are you losing because of bankruptcy, that is, without bankruptcy how much you will get, because of bankruptcy how much you will get, minus distress sale value into whole thing into probability of distress, So, this basically you can call this as A, this is A. Okay. So, now we are supposed to find out first what? Expected cost of bankruptcy. Expected cost of bankruptcy is equal to unlevered firm value. They have already given, no? 4321 lakhs minus distress sale value. What is the value of distress sale? If you sell on distress, 45% of PPV of 6143. So, 45% of 6143. This is what you will likely get. Okay. Whole thing into probability of distress. What is probability of distress? 34.67%. So, you get 6143 into 0.45, you get 2764.35 plus 4321. I changed it into minus and then I added 4321. I will get 1556.65 into 34.67% into 0.3467. That is equal to rupees 539.690 lakhs. Okay, this is what? This is expected cost of bankruptcy, which is basically this A. Now, this A is substituted in the overall number. So, firm value equal to, and again here also we do not have any debt. If there is debt, eventually you will subtract the value of debt. Firm value equal to unlevered cost. What is unlevered cost? We have here, no, 4321. 4321 plus tax benefit from debt, which is 0, minus cost of bankruptcy. What is cost of bankruptcy? This is the cost of bankruptcy, minus 539.690. How much value are you going to lose, and expected value that you are going to lose because of bankruptcy? Basically, if you are bankrupt, you will only realize this. So, if you are going to realize this, you are going to incur a huge loss. What is the probability weighted loss? So, here this is your ideal value, but this is the money you are going to recover. So, the difference between those two is loss. What is the probability of that loss? 34.67%. So, probability weighted bankruptcy, probability weighted loss in value of the firm due to bankruptcy is 539. So, that you are subtracting from the value of the company. So, you get rupees, again change it to minus and then add 4321, I get 3781.310 lakhs. APV is this. Okay. Now, in this, all of these, I purposely did not take debt because it will only add further complication without adding any great, there will be a lot of sound, very little light. So, I wanted to specifically do without debt in all the problems that we have solved, because you can directly subtract the value of debt independently. If you understand this logic, everything else is simple was. Okay. So, we have finished 3 kinds of problems in as far as our distress company valuation is concerned. Okay. Now, let us move forward. Friends, after getting a brief understanding of the power law, how that multiple works and all of that, let us look at a question. And this is again a simplified question. Peak 47 partners invest in a startup a sum of USD 3 million. Okay, they invested 3 million. Startup is expected to become a unicorn in 7 years. What is a unicorn? $1 billion valuation in 7 years. Peak 47 has IRR expectation of 25%. Very good. What is startup's pre-money, post-money value, and what is stake of Peak 47 partners at the time of initial investment, assuming no further investment by it in subsequent rounds? Okay, so if no further investment is made by it in subsequent rounds, okay, and it needs it to compound at 25%, what will happen? Let us look at the solution. Value of startup after 7 years, USD 1 billion at IRR of 25%, value as on date is equal to, what will it be? 1 billion, that is 1000 million divided by 1.25 whole power 7. Simple, nothing else. So, 1000 million divided by 1.25 is equal to 1, 2, 3, 4, 5, 6, 7. That is equal to 209. It is 7 years only, right? Yes. 209.7152. 209.7192 million. This is a value as on date. What is the questions that they asked? What is startup's pre-money, post-money value? What is status of Peak 47 partners, stake of Peak 47 partners at the time of initial investment? So, post-money value is equal, this number is post-money value, 209.7152 as on date, less investment, 3 million. So, pre-money value is how much? 206.7152. Stake of Peak 47 partners is equal to 3 by 209.7152, that is 1.43% as on date. Okay. Very simple problem. I have not complicated anything. Even though I have explained in detail quite a few other things, in this question I have not used all the tools that I have explained you. Okay. If they give you a question like this, how are you going to solve? Very simple. Whatever valuation you are going to get, that is post money. From that you subtract the investment, you get the pre-money. The investment divided by the post money valuation is basically your share. That's all. Very, very simple. Nothing else. Okay, so this is a small, very simple question on valuation of a startup using the VC method. Okay, let us move forward.